Today I wanted to discuss the USDINR, and before I get into the charts, its movement with the dollar, with the emerging market currency space, I just wanted to go over an issue, and that directly relates to demonetization that was done some time back in the introduction of these 2000 rupee notes. Now it was in discussion for quite a while as to whether these 2000 rupees notes would be taken out of the market. Would they be replaced by the 1000 rupee note? There are lots of articles going both ways, saying either that it could be done or it wouldn't be done very soon. But as far as the experience on the street is, these 2000 rupee notes are still largely in circulation. In fact, the number of 500 rupee notes falls short, especially if you are an ATM user. And so you end up with a lot of big notes that you have to try and break up and spend, and nobody or a lot of shops actually deny to give you change for those large denomination notes, unless you're shopping for a larger sum. So that's one difficulty that continues. But the question still remains: why did they introduce these 2000 rupee notes? And it somewhere takes me back to one of my old videos on the USDNR, which for some reason is getting a lot of views. I don't know what form of views, because I'm not exactly promoting it, but a lot of it happened, and a lot of people are simply posting coin sales on that video, which is quite amusing. But the video really was about explaining how the coin system tells you a lot about the value of the underlying currency, which means that if the size of the coin, if all of you have noticed, at some point we introduced what was known as the 5 rupee coin. It was a pretty thick coin. The thickness has definitely come down. Then we introduced the 2 rupee coin, which then became the size of the 1 rupee coin. Then the 1 rupee coin became the size of the 50 paisa coin. And sometimes the metals are changed, sometimes the metal is the same and the size is changed. And each of these tell you something about the loss of value and the purchasing power of the currency itself. Because unlike a note on which you can print 1000, 2000, or anything, the coin essentially reflects the actual cost of production that goes into it, which is both the metal and labor. So labor inflation is also part of the pricing, and therefore even if the metal prices do not change, if labor inflation has continued to grow because of rising salaries, then that gets reflected in the cost of the coin, and thus the size of the coinage itself. And so the coin itself gives you the best, clearest picture of changing purchasing power. So if you've seen these coin sizes fall, you also, if your incomes have been constant, you would have definitely felt the direct impact of a fall in the uh, cost of living, purchasing power, or the experience that you have in terms of your lifestyle. And therefore, for most of those who are working, would actually end up looking up to their employees for higher incomes, which is a natural phenomena. So, what did this introduction of 2000 rupee notes really mean? That's a question that doesn't have a perfect answer. There are a lot of answers from the government and from the public at large. I don't know how many convincing, but I always think of it from the currency valuation standpoint, that if you're really introducing larger degree notes, what are you saying about the value of the underlying currency and about the potential for inflation? Now, either you would introduce larger notes when inflation is already there and there's a need, but definitely the way we are seeing transactions happen, the 2000 rupee notes are actually limiting transactions in the current environment, especially by not having that interim 1000 rupee exchange note available. So in a way, it's actually restricted. It's restrictive. If you look at the growth rate of money supply, which used to be an average 15% in India historically, it's actually down to, it dropped to single digits, almost 8-9%. Now it's at around 11% odd per annum. The money growth, which is reported by RBI, so it's really not high from historical standards, though money growth continues. And so, whether that's a reflection of inflation. So, what did the government really think? Did they think that demonetization would cause a spike in the currency and a negative effect that they wanted to wear off by introducing a higher currency note, so that there wouldn't be any flight of capital? Possible, various different angles that you can look at it, but the fact is that this note remains around, and as long as it does, it raises a doubt as to the current or future potential impact in terms of either a loss in the currency value or uh, purchasing power itself. that is being anticipated here, but has still not happened. Now I wonder. So till we get the introduction of those notes now, let us look at what the currency has actually done. Historically, we've been at a lead lag with the dollar index itself. We don't always move at the same time, but on a broad scale, the trend and direction for most currency pairs remains the same. So if you look at the dollar index and USDINR on the same chart as you're doing right now, then over several years you'd probably see the same trend continue. You'd see the INR, USD INR going up when the dollar index is rising, and also consolidating. But then here you have this big move in the INR, not really seen that bigger move in the dollar index, and later you have this big move in the dollar index, not really seen in the USD INR. But during this phase here, the dollar index did continue still to a new high, and the USD INR was actually not responding to that trend. It spiked up only after the announcement of demonetization, even though the stock market itself was down. The USDNR was not exactly going up till that event, and then it really caught up with what the dollar was doing. And similarly, you've seen this very, very sharp decline in the USDNR, which is essentially a strengthening of the rupee. While we've had this very small correction in the dollar index itself. Now, a lot of this has to do with what is the deviation of emerging market currencies from the dollar since the start of 2015. So, at this point, I started saying that the dollar is going to fall. Maybe it has topped out. It has made one more new high after that. But one of the reasons was that the emerging market currencies were actually completing their significant waves, either third waves or so, which were slightly larger in time. So when you look at this chart, this is a chart of the USD BRL along with the USD INR. Again, you see something similar, that generally with the rising dollar trend, of course, the USD BRL also continues to move higher. But there are periods in which, like this initial period, where it looks like the rupee actually weakened much more than the Brazilian real did, although in percentage terms there's a lot of similarity. So overall, the real actually did much worse, even though it looks like in this phase the real fell much more than the rupee. But in percentage terms, the real has overall fallen much more than the rupee did. And in this phase here, but the direction remains the same. So when this is going down, you find that this is also consolidating. It's going up. It's also mostly going up. But then there are lead lags, and so we had a significant lag in terms of the USDNR going down during this period, when most emerging market currencies, and I'm only using the USD BRL or the Real here, actually fell. That is, the USD fell, and those currencies strengthened throughout this period between the start of 2016 and the end of 2016. And the rupee actually just stayed flat out there, correlating more with what is the dollar index than with the rest of the emerging market space. So you can pick any currency, AUD, CAD, or the ZAR, which is the South African rand, and you will see the same trend over there, that most of them were rising against the dollar, but the rupee was simply flat out here. And now, when many of them have started to show some stability, maybe the trend is not changed, but they've actually stopped strengthening. You have the USD INR just falling consistently, showing a stronger rupee, catching up with the emerging market space altogether at once. So this was a very interesting trend, but a huge lead lag. So if I just used the other currencies as a proxy to think, that the strengthening would show up in the INR itself, it didn't happen here, but now it's happened all of a sudden and all at once. So with this, let me go to the wave counts and analysis of the USD INR itself. So that's a lot of intermarket analysis, and here's one last piece before I go to the USD INR chart, and this is what I call the relative rupee, or rather it's just the relative strength of the USD INR versus the dollar index. Now this is interesting because it tells you how the INR is performing on a relative basis to the dollar index. Is it depreciating more or depreciating less? I initially plotted this in 2002 or 3, uh, and have been tracking it since, and I found it useful because every time this RS chart moved up significantly, you got a lot of inflation subsequent to that. So I thought it was a fair inflationary indicator, because a rising trend showed that the rupee was depreciating more than the dollar was appreciating. So that's a interesting fact. And you can see that throughout this period in the 90s, there was a very, very steep move, which is why by the early 90s, 92 to 94, you had double digit inflation running in India, some of the highest levels that we have seen ever. And then that stabilized into 2000, this phase, which you see slightly flattish phase, it stabilized, and then the next bull market really started. And then you had many small bouts of inflationary numbers showing up. The first time in 2005, then you had some rate hikes, then again in 2009, 10, we had pretty significant numbers again going into double digits. So although this advance is much less steeper than what we saw in the 90s, but we did get several rounds of inflation during this phase, and rates had to be raised each time. And then you had this last one, when the USDINR actually went to 69. You had this lagged effect of inflation for pretty long time, which is now more or less cooled off. We are getting some uptick in near-term inflation, with the RBI is worried about, but this pair itself has for the first time in many years broken the lower end of this range. I don't know whether this break is a reversal in trend or whether it's a temporary break. So we'll be watching this for some time. Maybe this previous swing low for the indicator itself would be a point at which you could take that call. But till we are above that, maybe it's just a false break. But still, it's a significant period of strengthening of the currency since 2013 till today. That has continued on a relative basis. So even though the USDINR has gone back to 69 relative to the dollar and relative to other pairs, we actually far stronger right now than we would think, and that sets us up for, and this is my view, for a much more weakening. There's room, and there's also probably a need for a weaker currency uh, from a general economic sense of where we are. Because if you actually keep strengthening this, also there would be huge negative effects, deflationary, or as an impact to your export capabilities, and which are mostly price based, unless you have products that attract value. And for most emerging currencies, or those who are producers of commodities, or if you're essentially exporting labor as a commodity, then pricing is everything. So in that sense, this is not good news and has a direct negative impact on most of those sectors. So here's the really big picture chart of the USDNR that I post in my monthly newsletter. And this is a yearly chart. It dates all the way from when we were on a silver standard at the start of the previous century, all the way back to 1890, and then based on some back data I was able to find online, which I'm not able to do anymore. I just plotted this chart, and you can actually put it in a good rising long-term channel, and I've managed to mark 1, 2, 3, 4 waves, and we are probably in the fifth, and that's the one that we are trying to break down into an impulse 1, 2, 3, 4. And the question essentially has been, is the third wave over? So I'll go to the next chart. This is a discussion as to whether the third wave, uh, this big picture, has completed or not. Okay, now there are two ways of looking at it. For a long time, this has not been my preferred view that the third ended here, and so I'll come to that chart as well. If it has, then we'll probably see a steeper correction, maybe down to even 63, another rupee lower from where we are right now. But then again, that itself would not be complete confirmation, but definitely there are a lot of indications, like the monthly momentum cycles that have completely pulled down back to the zero line, as an indication that this cycle may be complete. But that said, the real issue comes in this space. So I will come to that in the next chart. But essentially, if you have completed a third, even at larger degree, you could be in a fourth wave for a pretty long time if it's a complex correction. Or simply you could touch the lower end of this long-term channel near 63 and take off into a fifth wave up. So in terms of trend reading, whether I go with this particular wave count or the next one that I will discuss, both of them would indicate an upside either from current levels or maybe from a rupee lower. The only thing that I cannot rule out on this particular count is that if you're in a long-term fourth, you can form a triangle which can become a multi-month or almost a one-year kind of affair. And so that would be time consuming. But if that's not the case, it could be simply touch and go. And somewhere in my mind, for a long time, I thought it could be touch and go. So I'm going to look at the next chart of the USDINR to essentially discuss that scenario. And this is the scenario that was my primary wave count for a pretty long time. Note what I've boxed over here is that while visually you can draw a running triangle around the space, my sense for a long time was that this secondary rally was also impulse. So when these moves actually started in the market, I've always marked this as 1 2 and 1 2, and then the third wave from here, which went into 69. And if I stick to that original count, and I found many times that the original count eventually remains as the best count. Then this was a third wave, fourth wave, another third wave, fourth wave, and we just completed third, fourth, and the fifth of this structure is actually still not complete. So that remains the mental doubt. The 23% retracement for this comes in at 64, and we are almost very close to that within 10 paisa or so. And the readings are pretty oversold. This is the daily RSI. It has hit 19 at least 3 times since the INR hit, hit this low close to 65, and this entire rupee drop again we've been in this low end, and we are here today we are actually trying to attempt a bounce back, but these RSI readings close to around 18 to 19 are an extreme, and an indication that as and when you get the next reversal it might be significant. On the other hand, the weekly RSI is also down to around 23, which is again significant. So historically, bottoms have occurred on weekly RSI of around readings much lower. In this case here in 2008, you dropped to almost single digits. Here around 13, here around 8. So you had very low readings. And so in that sense, if you're at 23, you can argue that, well, much lower readings are possible. But on the daily chart, this consistently low reading provides room for you to think that maybe you have a near-term bottom at least, maybe some bounce back. But again, that's not worked the last 2 times, and so this could simply be a free fall going on. But that brings me back to this chart discussion that somewhere at either the medium-term degree or the long-term degree, we are completing a fourth wave, and a fifth wave up remains pending. If this count is more correct, then the fifth wave up should start more immediately once the sell-off ends from this very oversold condition. You should immediately turn up and start the fifth wave higher. However, if it's a larger degree fourth as shown in the previous chart, then it would end up being possibly a multi-month or a year or two kind of consolidation into maybe a triangle or a complex pattern before we actually move higher. So one of those are one of the two options, but in either case, the next move would be up either from here or from a rupee lower than here, is what I'm sensing for the USD INR right now. And if this count is correct, then the fifth wave would essentially mean going to new highs beyond the 69 mark, which is still possibility. And if you simply project after an extended third wave that a fifth wave would be of equal size to the first wave, then you would end up closer to around 79 overall, which means if you hold the support close to 64, 79 would be a possibility. But we're going to have to wait and watch for an actual signal that the trend down for the USDNR has essentially reversed. That has still not happened. We simply have readings, we have wave counts that indicate what the bigger picture is likely to be. But in the short term, you need to actually fine tune the low point, see what forms before and get an actual trend reversal signal before one can actually take any action. So that's all in this update on the USDNR medium term, long term, and short term from me for today, the 10th of April 2017. Thank you.